question that I get asked all the time is, do I need long-term care insurance? And the answer is, quite frankly, well, it depends. It depends on your family history. It depends on how likely you are to need it, and if this is going to be a large financial burden for you. So all we can really do is go off of statistics and look at things like the Department of Health and Human Services, like you see below, stating that 70% of people will need long-term care, a service of long-term care in their future. So what exactly does that mean from a cost perspective? Well, what we know is that long-term care costs today are pretty expensive. A private room can cost over $100,000 in a long-term care facility, and that cost is only projected to go up by 34% until it gets to 2030. So I wanted to give to you today another option to consider when you're thinking about financing future potential long-term care costs. And that is a really simple answer, which is funding a health savings account, an HSA. Now you have to have a qualified health plan, a high deductible plan, but what you can see in this graph below is that if you funded an HSA and max that out every year from age 50 till age 65 when you retire, the amount of money that you would have in an HSA would be upwards of $250,000 by the end of that time frame. And that money can all be used for qualified medical, including long-term care costs if you needed some of those. And that amount would only grow in the future because you can invest and continue to see HSA balances compound and grow. And the neat thing about HSAs is that as medical costs come up during those 15 years or longer of when it's growing, if you pay those bills out of pocket and save the receipts, at any time in the future, you can then do a withdrawal from the HSA and take out those funds as a qualified distribution that go against the costs that you already paid for. So over those 15 years, if you had $100,000 in medical costs, at age 70, you could then take the $100,000 out tax-free because it was qualified medical. So they're really versatile accounts. They can be used for medical. They can be used to hedge against long-term care. And if you don't need it, it's not all lost. The money does pass down to your beneficiaries, and you can take that money out at any time if you have those qualifying offsetting medical expenses during your lifetime when you were participating in it. So they're really great accounts, and just wanted to offer this up as another option because long-term care insurance is really expensive because the costs are expensive. But this is just another option to consider that allows you to efficiently self-insure or potentially self-insure against those known long-term care costs that most of us are going to face in our lifetime. So thanks for watching, and reach out with any questions that I can further help on. Take care.